So if you're the incoming Treasury Secretary, and we'll get to whom that person might be in a moment, and you're looking at the 10-year yield today at, roughly speaking, 440, at what point does that person need to start worrying? Is there an inflection point where that individual, he's going to be a guy, where that guy should think to himself, wow, we're crossing a Rubicon here, the market is beginning to freak out, and we need to start being really careful?
Well, I think the equation is reasonably simple, is how much tariff do I want to do? And I do think they're very serious about doing tariff. Tariff brings inflation, it brings revenue. What do I do with the revenue? Then there are all sorts of promises. I can't tell the one that the new administration will follow. Giving tax cuts to wealthy people is probably not the most conducive thing that one could do. And so you need to put all of the elements into the package, kind of look at where it brings you. And the fact that the deficit is unsustainable over the long run, and that at some point in time, the bill comes and you have to pay the debt. And it's interesting that we're already at a situation where the interest rate paid on the debt is the same than the defense budget.
Yes, greater in fact.
Greater. If rates go up,
it just keeps climbing.
Keeps on climbing. So the margins of error are actually not that wide, and you can make a perfectly reasonable argument that the Trump administration will have less leeway than they wish they had because of the constraint and the initial condition.
Is there a yield at which you would say the bond vigilantes are back?
I think they're back. I think you have a series of people. I mean, look, you interview some of them on TV, and they have a view that the back end of the curve should go higher.